names are lower again in what's been an especially difficult week there. It does take us to our talk of the tape. What has the AI mania, has it gotten out of hand? Here's what the billionaire investor Ken Griffin of Citadel said on CNBC earlier today in an exclusive interview.
There's obviously echoes of the dot-com bubble in this moment. All right, and let's take a step back. The dot-com bubble, there was a huge amount of capital that flowed into what today we refer to as the internet. Now, the true winners and losers were not readily identifiable at the start of that whole bubble. But move forward 10, 15, 20 years later, there's no doubt that the world was radically transformed by that moment in time.
All right, that's Ken Griffin. Now let's welcome in Fundstrat's Tom Lee, a CNBC contributor. It's good to have you back. I know you love this trade, but what do you make of what Mr. Griffin had to say?
Well, I agree with him. You know, we're in a period where there is a super cycle and exponential growth opportunities within AI. But it doesn't mean every company that has elevated valuation today deserves to actually have the capital, and that company may not even reinvest that capital properly to be a survivor. So I agree there is going to eventually be a shakeout, but I think valuations, strangely enough, are actually pretty reasonable today compared to 1998, because, you know, 1998 was that liftoff point before that final 18-month surge. And I'd say the best benchmark is NVIDIA trades at 26 times forward earnings. Cisco at that same exact moment was at 60 times, and Cisco's PE peaked at 210 times forward earnings. So NVIDIA, to me, is still a bargain at 26 times. It's cheaper than Costco and Walmart, which are close to 50 times forward earnings.
Sure, but all valuation isn't created equal. And I'm not especially clear as to whether Mr. Griffin looks at the valuations of an NVIDIA, for example, and says, well, that looks a little out of hand. It reminds me of late 90s activity before the dot-com bust happened, as much as he looks at other names which have gone, you know, parabolic, and they're related to AI. And that's where he says, whoa, 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 whoa. We're placing way too many bets on what might happen in the future. We think we know what's going to happen in the future as it relates to NVIDIA and some of the other hyperscalers, but it's a whole host of other names that have literally ripped over the last 3 months, at least, that might bring investors a little bit of pause.
I think that's correct, Scott. There's a difference between a company being scarce in the public market. Like, let's say there's an IPO of a company and it's the only way for you to get exposure, versus that company being truly scarce to the ecosystem. So I do think investors have to discern, is this company going up a lot because this is the only name out of a possible bevy of private companies, or is this the company truly unique and one that is so scarce I got to give it the N=1 valuation?
I mean, I think he looks also at a stat like JP Morgan Asset Management's Michael Sembalist brought to us today from his report. And he's good at what he does, okay? Quote, AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. Now, some would say, well, obviously, and all of that might be justified, but those are large numbers. Those are really large numbers that have carried a boatload of the weight of this move in the market since then.
Yeah, and that's a moment in time, Scott. I mean, just to give some perspective, NVIDIA is about 8% of the S&P 500 market cap weight, but it is also 7% of the earnings. So it's not necessarily distorting equity valuations. And in terms of what companies are excited about, you know, if companies are saying that AI is something where they're actually allocating capital, and many are, of course, are seeing productive gains, I think it's justified that that would be what you'd expect to be the first wave of investment and spending, is around directly into the ecosystem. But of course, over time, we'd expect that spending then to deliver productivity gains and other benefits. So that means if AI, and you know, I'm comfortable with the idea it's a super cycle, we should see a broadening of the benefits and then also the broadening of opportunities over time. So it's probably a moment in time makes sense, but it should be broadening.
I mean, I look at a stock like Oracle, for example, only to pick it out because it's up more than 30% this month. Now, it obviously had the moment around earnings where it added such a tremendous amount of market cap after that event. I bring it up if only because it was initiated sell today at one firm on Wall Street, in part because they suggest that you've got some really aggressive assumptions that are coming with this stock. Now, it's down 5% today because a lot of these names in what you would consider the momentum basket have rolled over a little bit. But the notion that the assumptions are so big that there's inherent risk in and of itself within that.
Scott, I think that there is going to be moments where it feels like we're possibly topping, and today is coming at a time when we have this Oracle report and stocks are generally soft. But number one, I think it's always really healthy to see corrections in a super cycle. But I do think it's really difficult for someone to actually ring the bell at the top. And in fact, whether we take like if we look at Palantir or Tesla or NVIDIA, I think that there have been, 25 bell ringings at the top at every waypoint along the way. To me, I think the real test is going to be that we see a day where investors are convinced there's absolutely nothing that is wrong with the thesis and it's bulletproof, and yet stocks make announcements and they go down, and companies actually have negative returns. I have not seen that yet. In fact, to me, it's reflexive to see that every time markets flatten out after posting gains, we have a lot of people declaring the top. To me, that's a really healthy sign that there is very little conviction about this bull market, and I do think it's healthy to actually see the skepticism. So I'm not opposed to seeing these reports, but it's healthy.
Do you think that equities are especially vulnerable here, as we wrote in our intro today, as BTIG suggests they are? The most since the April low. Do you feel the same? I should also mention it comes within the same context of commentary recently from the Fed chair, who didn't go out of his way when he answered the question about the equity markets to suggest it's wildly overvalued. But nonetheless, he did say that stocks are fairly highly valued. He could have said, I think they're fairly valued. He didn't. He said they're fairly highly valued when he answered that question. You put that into the mix, too, when you consider your answer.
Yes. Well, I have a lot of respect for Fed Chair Powell, but I don't remember the last time any FOMC member actually said stocks are attractively valued, because I don't think it's their job to comment on equity valuations that way. And if we think about where, again, market valuations are, I'd be very concerned if the most important stock, like NVIDIA, was trading at a multiple that couldn't deliver returns. But it's the most important company in the world, 40% plus revenue growth. It's trading at 26 times forward earnings, which is hardly demanding for a company that makes a product that every single company in the world that is involved with AI actually needs. They can't replace it with anything else. So I don't think it's expensive. When you ask about April lows and valuation vulnerability, I think there's really two big differences. One is monetary policy was actually quite tight in April, and the risk was actually the Fed wouldn't even consider intervening, and yet markets managed to stage a 30% rally. Today, we have a Fed that's not necessarily pounding the table that it's in a dovish cycle, but they've understood that they need to now use their hand to support employment. That's a sea change, actually. And as we know, ISM's been below 50 for 31 months. It's the longest stretch in the history of the ISM index. I think if the ISM breaks above 50, that's a recovery in confidence in capital spending. That would support a broadening of the economy, and I think that would be good for equities.
Well, speaking of Fed policy, and you stay with me, Tom, for a moment, Ken Griffin also gave his outlook today for what he thinks the Fed will do after cutting rates last week. The billionaire investor said he sees only one cut over the remainder of this year, outside chance of two, as inflation remains higher than the Fed's target of 2% and may still get worse.
The belief is that the inflationary impulse from tariffs has only passed about 50% through to the economy at this point in time.
So you see it coming,
Oh,
tariff
it's
inflation?
still coming. It's still coming.
It's still coming, he said. He also weighed in on the issue of Fed independence. Listen.
If I were the president, I would let the Fed do their job, and I would let the Fed have as much perceived and real independence as possible, because the Fed often has to make choices that are pretty painful to make. And if the president's perceived as being in control of the Fed, then what happens when those painful choices have to be made?
Joining me now is the Wall Street Journal's chief economics correspondent, Nick Timmeros. It's great to have you back. Nice to see you.
Thanks for having me, Scott.
Seems like Mr. Griffin is aligned with many on the Fed right now. Maybe you'll get one, but there seems to be caution expressed by many of the Fed speakers we've heard this week, including today. Austin Goolsbee said, quote, "I'm just a little uneasy with too much front loading until we're sure that inflation is coming down."
Yeah, that's right. I think what you're hearing is there's a debate about whether you cut in December. October seems priced in here. It's hard to see what would change the committee just because there's not that much data. And if there's a government shutdown next week, who knows what data we're going to have in hand. So it feels to me like there's a debate around, do you do more than 2 this year? Do you do December? If you do 3 this year, what's your stopping rule, right? The Fed, when they're cutting, the question is, when do you stop? When you're holding, the question is, when do you start either going up or down? So to me, that's the key question right now is it going to take, more deterioration in the labor market for them to keep cutting? Or do they need to see evidence that things are actually stabilizing before they go back on hold?
Well, I mean, they're in an especially tricky spot, don't you think? And it's, I think, why the chair himself has gone out of his way to make it clear when he says there are risks on both sides, that nothing is firm on where all of this is going. If they cut too much because they end up more concerned about the labor market and that spikes inflation, then they've caused a mess.
That's right. I still think the Jackson Hole speech was important. The shift at Jackson Hole was really the first time Powell came out and said, we think we can treat this as transitory inflation as a base case, and will have to be proven wrong. And of course, no matter what you do, you're going to have to wait some time to see if your initial assumption was wrong. So, how long is the Fed going to be comfortable taking that view, given, as Ken Griffin just said, it could be a while before we really see the peak, even if it's sort of a longer and flatter peak on the resumption of inflation pressures. So the issue there, I think, is what is the Fed going to see that's going to tell them you could be nourishing a cycle of more persistent inflation as you continue to lower interest rates? Is it something in the labor market? The housing market doesn't seem to be a threat here to reanimate price pressures. So where is that going to come from?
You think that the Fed chair fears what Ken Griffin said earlier today? It's coming. It's coming, when he talked about inflation from tariffs is just yet to show up in any meaningful way?
Well, you hear people say that it's coming with respect to more labor market fragility. So when he says there's no risk-free option here, look, in 8 months or 9 months or a year, it's going to be obvious what the Fed should have done. But sitting here today, a couple of weeks ago, people were reacting to the pop in jobless claims. You can find measures of labor market slack opening up if you look hard enough. And so maybe that is where you should be worried right now. And then, of course, you do have this concern that inflation's been away from the target for a while. I think the key question, though, Scott, is going to be what would actually nourish inflation pressures from a one-time increase in goods prices?
Lastly, Nick, what'd you make of the Fed chair saying of stocks they're fairly highly valued? As I suggested, I don't want to make too much of it. He didn't go out of his way to offer this up, but it is how he answered the question. And when he speaks about something like that, we listen.
You know, it didn't make much impression on me because this is something that's been in the Fed's financial stability report for a while now. They've been referring, at least the staff has been referring to asset prices, risks around those valuations as notable. So it sounded to me like he was sort of repeating something that the Fed has been saying really for several quarters here when it comes to the stock market. But obviously, a lot of people glommed onto it. So, maybe I missed something there.
Well, it's the Fed chair. When he talks about the equity market, we glom onto it. Nick, I'll see you soon. Thank you. Nick Timmeros with the Wall Street Journal. Of course, Tom Lee is still with us. Let's wrap this, Tom, with your reaction to a little bit of what Ken Griffin said. If he's right, and we have one cut for the remainder of the year, and that in his words, it's coming about inflation from tariffs, would your forecast for this market be wrong?
Scott, if the Fed does one cut, I think that markets would interpret that in a good way, in the sense that they'd rather see the Fed cutting into a strong economy rather than weak. So I don't think that that's necessarily a negative. But I think one thing that needs to be clarified, because I'm listening both carefully to what Nick said and what Ken said about inflation coming, there is this idea, and Fed Chair Powell talked about it, which is that there's the imputed effect of tariffs coming because these tariff costs have been absorbed and now they're working their way to the consumer. That's what the Fed would call an imputed inflation rate. That the effect was already felt, the charges are in place, but it takes a while for it to show up in a statistical way. That was exactly what happened with the housing prices, that housing prices surged in 2021 and 2022, but it became imputed inflation in 2023. We know that the Fed was lagging in its easing because of that imputed shelter inflation, but the reality is they should have been easing sooner, maybe not 50 initially. And so I think that we have to be careful. When the Fed's talking about that imputed effect, it doesn't mean we have to start a new hiking cycle just because it takes a while to show up. And I think that's why markets are going to see through that.
Tom, we'll see you soon. Thanks for being with us through our A block. That's Tom Lee of Fundstrat. We're also